I'm Cynthia Rowland, and this is episode 44 of EO Radio Show. This week, I'm delighted to have as my guest Stephanie Hood, my colleague here at Farella and a member of our top-notch estate planning practice. Our charity clients often come to us with a request to help a major donor think about a special gift to the charity, and sometimes we also get pulled in to help the charity when there are glitches in the trust or will after the donor has passed. And of course, many of our philanthropic clients ask for help in describing their charitable intent in their estate planning documents. So today, Stephanie and I will talk a little bit about planned charitable giving, including some tips and some common pitfalls to watch out for. Welcome to the EO Radio Show, your nonprofit legal resource. Brought to you by the Exempt Organizations Group at Farella, Braun and Martel. My name is Cynthia Rowland, and I'm a partner at Farella. I'm a business and tax lawyer with more than 30 years of experience advising clients on nonprofit and charity law. Through this podcast, our lawyers and guests will discuss a range of legal and business issues impacting the nonprofit world because we understand you work hard every day to make your community a better place to live and do business. Many of our programs focus on the basics, and at times we'll do a deep dive into narrow and complicated legal issues. Again, welcome to the EO Radio Show. We're glad you're here. So I'm so happy today to be joined by Stephanie Hood. Stephanie works with individuals and families to implement tax-efficient estate plans that stay true to the individual needs of each of her clients. She advises clients on a variety of domestic and international trust, estate, and tax matters. Stephanie helps individuals and families with the design, preparation, and implementation of their estate plan. She's experienced in tax planning techniques and valuation discount strategies that minimize income, gift, and estate tax consequences for multi-generational wealth transfers. Stephanie is often called on to help clients meet their philanthropic objectives as well, while maximizing tax opportunities both for lifetime gifts and for bequests. In addition to the lifetime planning, Stephanie helps the families and the fiduciaries through the postmortem planning and trust and estate administration process. Recognizing that each client and family situation is unique, she has great solutions for difficult funding, distribution, and transfer issues. And a lot of times this involves charity, so that's our main focus today. Stephanie is also a licensed CPA, and she's admitted to the bar in California, New York, and Florida. So thanks so much for joining me today, Stephanie. It's really great to have you here.
Oh, it's great to be here, Cynthia. Thank you for inviting me on and excited to talk about all things exempt organizations.
That's great. So tell the listeners a little bit about how you ended up going through all the education to be a CPA and a lawyer, and now you're doing estate planning and estate administration and have this special expertise in charitable planning as well. How'd you get here? Did you start out as a teenager? This is what I'm going to do?
Yeah. What every teenager desires to be, right? Lay in bed at night thinking, how can I be do all of these things? No, I actually had kind of an interesting way and route to getting here. So in college, I was, for whatever reason, taken with accounting and finance. And that was really, I had majored in both. Coming out of college, I got my CPA license and actually went into auditing of public companies with Deloitte & Touche. And through that process, had the interesting experience my first year actually as an auditor, running into a fraudulent client. So when I was first staffed on the client, we had no idea. And through the course of the audit, we discovered that it was a public company, was committing massive fraud. They actually had the FBI bring the CEO out. It was really a wild experience as a 20-something-year-old. But throughout that process, what I came to realize was I liked a whole lot more what the attorneys on the other side were doing as opposed to what I was doing as the accountant. So after a little bit over a year of doing that, I decided to stop doing the CPA, just strict accounting route, and go back into law school to kind of get the legal background for it.
Wow. Okay. So that's an interesting first job. Sounds like it was quite dynamic. So then you went to law school. You must have taken a lot of tax and planning classes and then started working in the great field of estate planning and tax.
That's right. So in law school, initially, I thought I was going to do something really exciting, like white collar crime. I was coming off the adrenaline of this fraudulent client audit, and then soon realized I just didn't have the appetite for that kind of litigation. It just wasn't in my personality. I'm far too passive of a person to deal with the stress involved with that. But I did really take to the tax classes and the estate planning and fiduciary classes. So I went to University of Florida for law school. They actually have a tremendous tax program, really took to it, got an internship with a law firm in Florida. Of course, everybody goes to Florida to die, as they say, since there's no taxes. So in that process, they had a great estate planning program. I worked in my summer internship with the estate planning group, and that really solidified it for me. I knew I really wanted to pursue estate planning, the charitable piece, the administration, both lifetime and postmortem, and then, of course, all the planning documents that go into place before all of that.
All right. So let's dive right into charitable bequests. When you're talking with a philanthropic client, how do you help them think through what assets are suitable for charitable giving and which kinds of assets might be really challenging to give to a charity?
That's always kind of the first conversation, as I'm sure you deal with that as well, Cynthia. Kind of like getting an overview. Let's talk about your asset mix and what do you have here? Of course, what's really attractive to give to charity are the low basis assets, the assets with a bunch of built-in capital gain that the charity wouldn't recognize, but you could get the benefit of the deduction with. I think sometimes, particularly with maybe some of the tech clients, some of the harder assets to deal with are the assets of maybe like private companies, particularly if there's no like pending sale, stuff that like the charities might have a hard time, illiquid assets that the charities would have a hard time getting rid of. So I think I really focus on, let's look at your built-in capital gain assets. Retirement accounts are a great option with that. And also assets that the charity can easily sell, liquidate, and have the proceeds from.
In charitable planning, there's kind of two sides to this. One is lifetime gifts, which can reduce your income tax. It reduces the size of the estate, so the overall estate tax exposure goes down or is minimized. And when the bequest is made, there's no income tax deduction at that point, but it does reduce the overall size of the estate. If we're just thinking about a bequest, so just shifting away from the lifetime giving, sometimes we see a percentage goes to charity and sometimes it's specific gifts. Any thought process that you go to when you're looking at different kinds of assets that might be split up among taxable beneficiaries and the charity? Or do you like to steer the whole, a particular asset to charity as opposed to a portion of everything?
Yeah. So I think it kind of depends on the client. Some clients say, I want to keep everything up to the estate tax exemption, for instance, to go to family or friends, and then everything above that to a charity. In that kind of case, it might be a little bit more difficult to flag specific assets. But in the case where maybe that's not the plan, to the extent we can flag specific assets, I always think that's a great idea. It's good to kind of vet those and get a sense of, how those are going to be in the administration process. Is a charity going to be willing to accept them? What are the possible issues we have with regard to that? How can we get ahead of any of that before something were to happen to the person? If a client sort of wants to make massive charitable gifts to the point that maybe you can't just flag a bunch of specific gifts, or the revocable trust plan says, I want to, give 2/3 of my estate. Well, we don't know what the values would be at death. So in that case, what I would say is leave a lot of flexibility in the funding provisions of the trust so that the trustee has a lot of discretion to choose which assets are ultimately allocated to charity. So that it doesn't have to be like 1/3 of every asset. The trustee can choose this retirement account or this low basis asset. And then maybe this house isn't a good asset for the charity for whatever reason, and we give that to your brother type of thing.
So you can leave discretion with the trustee, it sounds like?
Yeah, absolutely.
So how much discretion is too much for the trustee? Any boundaries on that?
I like to give the trustee a lot of latitude in choosing the assets for charity. An independent trustee, even better. But generally speaking, I think you can give the trustee a tremendous amount of flexibility. And I always would encourage clients in the planning process to make it flexible. We don't know what the world will look like when you pass away. We don't know what the exemption levels will be. We don't know what the political climate will be. We don't know what the economic climate will be. And we don't know what any of the value of the assets or anything is going to be worth. So I think to get ahead of that, choose people in the documents that you trust. If you don't have a cast of characters to choose from, choose institutions that you trust to act in this fiduciary role, and have the discussions during your lifetime of sort of what your objectives are. And then put a lot of trust and faith in the trustee to choose and make the decisions ultimately with regard to which assets should go to the charities.
So that's deciding which assets go to charity. Let's shift focus a little bit to which charitable beneficiaries. So is it necessary to name specific beneficiaries, or just talking about charitable beneficiaries? Or can you leave it flexible so the trustee chooses the charities? And similarly, if you do want to name a specific charity, what's the best way to do that?
So, of course, you can name a specific charity if you wanted to do so. I would say the more specificity, the better. Include the tax identification numbers, go through the process of going on to GuideStar or pulling their 990 return, making sure you're correctly stating the name. A lot of what we think might be the name, or you just kind of casually refer to it, isn't actually it. So take the extra step to make sure you're naming the correct charity that you're actually intending to, if you want to. But I also think there's a lot to be said for leaving it in the trustee's discretion. You will have a pattern during your lifetime of making lifetime gifts, and that pattern may change. The institutions you support when you're 20 may be different from when you're 40, may be different from when you're 60. So assuming you don't want to have to constantly readdress your underlying trust documents, leave it to the trustee. Keep records of where you're making charitable gifts so a trustee can look at it and say, okay, this seems to align with where they're thinking, where their priorities are at this time. So if you were to pass away, the trustee can choose institutions or charities that align with sort of your gifting goals.
Also, it reminds me of an interesting situation I had where the philanthropist, the father, he did refer to his lifetime giving, but he also specified a list of things that could not, and charities that he did not want funded, which is another way to approach it, and perhaps particularly useful to say, this is the kind of philanthropy that I don't want my trustee. In his case, the trustees were his kids, and he knew that they might have slightly different philanthropic ideas than dad did. So that's another way to approach it.
I think that's a great approach. The other thing I encourage clients to do is, in addition to just having contemporaneous conversations with the trustees while you're alive, have those periodic check-ins. This is where my head's at. This is what I'm thinking, particularly when you're leaving a large amount of discretion to the trustee. But in addition to that, I always encourage my clients to leave informal writings with their estate planning documents, just here are my thoughts. This is what I value, when making these decisions, this is where an example of what I don't want it to go to, like your client, Cynthia, or, here's kind of where my head's at. We have this political climate and I'm enraged by this and I really want to support these sort of organizations. That may be irrelevant in 4 years, but then you can change that writing without having to formally. Of course, this is all precatory. It's not binding, but I think it is very helpful on an informal basis, particularly if you have family or friends serving in the trustee role. Just, hey, this is where I'm at right now.
So what about the idea of funding a private foundation, a family foundation at death? Do we need to have that foundation created before the philanthropist passes, or is that something that can be set up as part of the estate planning documents?
That can be set up and spring into effect at death. Again, I would say if you can get it set up during lifetime, a lot of times there's advantages to doing so, but certainly you can set it up as part of the administration post-mortem.
Yeah, I've seen that in some, particularly years ago, it was even more common that a charitable trust would be one of many trusts that's created in the estate planning documents. Creates a lot more work at the time to set up a new charity right then and there. A related topic, what if the charity I name in the trust doesn't exist at the time of passing? Charities come and go. They don't all last forever. Then what?
Absolutely. So that's a really good point. So I like to, when naming a specific charity, say, here's the charity and here's the tax ID or its successor and interest. Oftentimes a successor charity will come into place. And then if none, then that's oftentimes where I would encourage a client to build in flexibility for the trustee to choose at the trustee's discretion. On the other hand, sometimes you have clients that list like 20 charities and they're of the mindset, all right, we'll leave, one share to this charity if in existence. If not, then the successor organization. Otherwise, just have the gift lapse and there's 19 others probably that it still works too. So I think, again, it's just a conversation with the clients.
Mm-hmm. Any traps for the unwary? Any cautionary tales that you would want to bring up that are either fun to talk about or just things that should have been avoided?
I think the IRS right now, one of the kind of conversations that's happening in the estate planning world is the IRS is really coming down on appraisals. So I would say make sure you have a qualified appraisal that lists the exact date and the exact interest being given with the value. That the IRS has really come down on that, as well as making sure you have an acknowledgement letter that also has the same information on it. You wouldn't want an acknowledgement letter with a different date or listing something else. So just making sure you get everything together at one time and tied up in a clean little box.
Right. And the appraisal process is particularly important during the estate administration when the charitable gifts are made. Let's suppose we have an estate where there's a lot of taxable gifts, but you also have charitable gifts, and the value of the charitable gift really matters because it's going to, if you get that value wrong, you're going to have you may have a higher estate tax. Talk a little bit about conditions on gifts and how that might affect the appraisal process. So let's suppose I want to give away a piece of land, but I want a conservation easement on it. So at the time when I pass, I have this unencumbered real estate that I want to give away. But what the executor or the trustee actually transfers is a property subject to a conservation easement. Talk a little bit about what that valuation mismatch might create and how to think about that kind of a relatively complicated charitable gift.
Yeah, that can get really complicated. And the problem is you have to be aware that the value for the estate tax purposes and the charitable deduction might be different. And that discrepancy could cause a taxable result that you might not otherwise anticipate.
So it's all in the appraisals there and the planning.
It's all in the appraisals and the planning. That's right. The Internal Revenue Code stipulates that the donors may only deduct contributions made to or for the use of a charity. So if your restriction on the contribution causes it so that the charity cannot freely and effectively employ the transferred assets for their charitable purposes, you may be precluded from taking a deduction.
Oh, interesting. So there's a lot of traps for the unwary in there.
Yeah, there certainly are. And in the lifetime context, I think what I'm seeing a lot of people, I guess they're just not aware of this, is the assignment of income issues. I'm seeing a lot of clients that want to wait till the very end when it's already a foregone conclusion that, for instance, like a buyout of a tech company is going to go through. And then they think the day before they can give the gift to charity and get the benefit of that huge valuation and that huge deduction when the reality is there's an assignment of income issue and you're not going to get that benefit.
Yeah, you're not going to avoid that income tax. Family businesses. Let's talk a little bit about the pitfalls in, suppose the major asset in the estate is a family business and you've made some lifetime gifts to your kids in that family business. And now you want to give the remaining portion of it to the private foundation. What's the red flag there when you've got private foundation and family members owning a family business?
Well, certainly there's a tremendous amount of self-dealing issues that come into play. The other thing to be aware of is if you're ever going to run into any unrelated business income tax, UBIT, as we call it.
Yeah, that's a good point. A lot of times, the best gifts for charities are obviously cash, appreciated marketable securities, things that when the charity sells it, it's not going to trigger the tax. Debt financed property that goes to charity creates some issues, co-ownership with family members, and also just flat out inability to sell because the foundation has a minimum distribution requirement if it's going to a family foundation. There's just so many pitfalls for the fractional interest gifts.
That's right. Illiquid assets are often problematic. I've seen it before that, people are, again, a lot of these, the tech sort of stuff has sort of slowed all the acquisitions and buyouts. And unfortunately, I've seen it where the clients will make a gift to charity and anticipating that there was going to be a buyout and there's not. And now, the charity's kind of stuck with this privately held business that isn't liquid and it's causing a host of issues. I also saw an interesting case where somebody donated land and it ended up being problematic because the donation was in the testamentary documents for it to go to the charity. And after the passing, the charity kind of started doing their due diligence and looking around, and they sort of came into these issues where there might be a toxic tort. And that was problematic as well. So, I think anytime you can get ahead of it and sort of have the conversations ahead of time, because certainly that wasn't something that was expected. And I don't remember how it all resolved, but it was a problem.
Yeah, that's a really good point. The charity doesn't have to take the asset. And so having a backup plan for someone who will take it, or if it's just flat out a problem. And I guess that can lead to the overall estate tax financing question as well. I mean, when you're stuck with assets that are taxable.
Well, particularly with the estate tax, it's due 9 months after the passing. You can extend it for 6 months. The reality is these complicated administrations take a lot longer than that. And now you have a situation where you anticipated getting a very large deduction for a charitable, and the charity's saying, God, we don't really want this because this is a problem for us. And you've already made some distributions. You're just in the middle of the throes of the administration, and it really throws a wrench in it.
Estate administration is not a DIY task.
Certainly not.
And particularly with complicated assets. If the estate is cash and marketable securities, not much fun there for professionals like us. But when you're looking at assets that include like a family business or real property, other things like that, it can get a lot more interesting. Any final thoughts, Stephanie? Anything else you want to mention for our listeners when thinking about bequests or other resources that they can look to?
Yeah, I would just say, feel free to reach out to any of us. It is not for the DIY. It is something to talk about. There's a lot of information that we can provide to our listeners and just conversations we can have, just guiding them through the process, even if it's not, something that they need our assistance with all the way through, just sort of, these are the people to talk to, or these are good foundations to work with, or donor advised funds to work with. But I think it's just all about getting ahead of any issues that could be out there that you just don't necessarily anticipate when your heart and your mind is in a good place that you want to make a charitable bequest, and it actually can be a lot more complicated than it seems.
Yeah, that's a great way to wrap up the episode. It can be a lot more complicated than it seems. So thank you so much for chatting with me today, Stephanie. I really appreciate it.
Oh, thank you, Cynthia. Thank you for having me on. I really appreciate that.
So that's all for this episode. Listeners, be sure to check out the show notes for links to more resources. I'm Cynthia Rowland, and you've been listening to EO Radio Show, your nonprofit legal resource, brought to you by the Exempt Organizations Group at Farella, Braun & Martell. If you have suggestions for topics you would like for us to discuss, please email us at eoradioshow@fbm.com. That's eoradioshow@fbm.com. Thank you for joining us. Until next time, make a difference.